investors are being urged to prepare a defensive portfolio and to be ready to take advantage of the imminent significant opportunities that will likely present themselves. That's the advice from deVere Group in response to the IMF's latest World Economic Outlook report. Tom Elliot, deVere Group's international investment strategist, joins me now. Tom, the IMF's economic outlook, what's the key points we're looking at exactly?
Well, the key points, actually, the world is growing quite merrily at about 3.5% a year. Most economists reckon 3% is a little cold, 4% a little hot. So 3.5 looks absolutely fine. It's only when you read on that you see the ifs and buts. And really, I'm focusing on, I think, the main but, which is the risk that the IMF start raising rates earlier and faster than the market is pricing in.
So you suggest a defensive portfolio. What are we looking at exactly?
A sitting on the fence portfolio, really. It's as clear as mud, sort of the minutes from the Fed that came out recently. And so I'm just suggesting if you're following a benchmark that is 60% equities, 60% bonds, you stick to it and you just take on the chin whatever volatility is going to come if we do see this rise in interest rates.
I think a lot of investors are getting a bit tired there of being told to hold cash. Wouldn't you agree?
There is a sense that we've been waiting for interest rate rises to strike for some time. They haven't happened. Equity markets have done well in the meantime. High yield bonds have done well. But I don't think one should be complacent. Capital markets universally and property markets are on quicksand. We don't really know where firm ground is, and this has been caused by quantitative easing pushing up asset prices. And as QE and ultra low interest rates are taken out of the system, I think there could be some major shocks in all asset classes.
So what new risks have emerged that investors really need to be aware of?
Regarding the US equities look expensive. The only justification for carrying on buying US equities is their relatively attractive valuation compared to cash and bonds. Now, higher interest rates destroys that argument. The other area of weakness, and this is where the IMF picked up on its World Economic Outlook, is emerging market countries. Those with high borrowings, high current account deficits. Brazil, for instance, Turkey, South Africa, India. Some of them will be benefiting from low oil prices, but still they are having to borrow lots of money to keep growing. And as rates come through in the US, you'll have two things. You'll have the effect of local currencies falling against the dollar, so it becomes more expensive to borrow loans. And secondly, you'll have those loans will be more expensive anyway in dollar terms because interest rates have gone up. So countries with large current account deficits and the US, if I have to take active positions on a portfolio benchmark, I'd be underweight those and overweight perhaps Eurozone equities.
And economically speaking, when the US Federal Reserve finally raises interest rates, what's the knock-on effect, worst case scenario?
One can get extremely doom-like here and say, look, if the London housing market, for instance, was saved by quantitative easing and ultra-low interest rates in 2008-9, does it stand to reason that as rates in the UK eventually normalise, then London house prices have to come down to a level that could destroy consumer spending in the southeast and in the whole of the country? I think a lot of asset classes could be in for a rough time. But funnily enough, for an active saver with some time to go, there is a silver lining here, because if you're regularly buying assets as part of your pension fund, then you're going to be buying them at cheaper prices. Now, this optimism only works on the assumption that when you eventually come to retire, markets will have cleared and recovered and prices will be back to where they were. But it's called pound cost averaging, dollar cost averaging. That's the phenomenon that takes place. But it is well worth considering if you're an active investor, take advantage if we do have some sort of market correction.
And what trends do you anticipate impacting the market for the rest of 2015?
It's going to be very much a question of continued signs of growth in the Eurozone. And people, especially in the Bundesbank, they've never liked the Euro project, hate QE, saying, whoa, time to cut back on QE in the Eurozone, Mr. Draghi, never mind that 1.1 billion you promised, let's cut it back because it'll just create inflation. So I think that's going to be an interesting story. I think another very interesting story that we've got is the price of oil, which could go anyway. But just imagine if suddenly Iran comes on board, but not only over nuclear deals, but in curbing back Shia militiamen well, suddenly it might get permission and the technology transfer to pump out another 3 million barrels a day. Well, that would sink the oil price.
What do you make of so-called Quicksilver markets, the idea that US equities are overinflated?
Again, it comes back to this sense of overpriced, overinflated against what? And the only justification that people come up with is against very, very low cash deposit rates and bond yields. Once you get quantitative easing, unwinding, interest rates rising, well, that argument is destroyed and US equities aren't left with anything else.
So do you think we're on the brink of another recession?
I think that one can separate, certainly in the US, we can separate asset market bubbles from the underlying economy so long as they are burst relatively early on. US household borrowing is at a level much below where it was in 2008. Unlike in the Eurozone where it's about where it was. The effect now, if you burst the bubble, the asset bubble, and lead to weaker house prices, weaker stock market, shouldn't have quite the same impact.
So finally, should banks be taxed heavier? Because there is the argument that governments would spend more wisely than the private sector.
Taxing banks more is fiddling around in the shallow end. The real solution, if I may put forward, is to do this idea of a narrow bank. Retail banks should only lend out the money that depositors leave with them. And this is why the Icelandic experiment is so interesting. It inherently prevents leverage within the banking system. And investment banks that deal with partners' money to gamble on, they should be totally separate operations with absolutely no government guarantee behind them. We need to go back to the Glass-Steagall Act in the US and everywhere. And anything else is, as I said, playing around in the shallow end.